Thank you to our panelists for being here today. We have Bill Provost with Franklin Loan Center, Christian Dahlin, the Dahlin Lending Team, Tobie Love Team Cross Country Mortgage, our beautiful and amazing Tiffany Cross with Dedicated Credit Repair. And I also wanted to thank our real estate power team for putting these events together. So we have Bill Provost, Celeste Ducharme with Ranch RV and Self Storage, Garen Parker, New Season Properties, John Ruff and Ready Moving, Lisa Wayman, Corner Escrow, Lloyd Mize, Cowell Banker, Matt Smith, Trust Home Inspections, Richie Perez, Richie's Termite and Pest Control, Scott Peterson with Home Perfect Restoration, and of course Tiffany with Dedicated Credit, and myself, Marianne, with Lawyers Title. All right, so with that, I wanted to bring up Tiffany, our moderator for today. But first, Tiffany, I wanted to ask you a few questions just to kind of get the conversation started. When we're talking in terms of credit repair, I know of many people that have been asking questions, and I'm sure you are being inundated with phone calls right now with what's going on in terms of credit repair. So I wanted to ask you a little bit about that. Can you shed some light on maybe some of the themed subjects that you're getting questions on daily?
Absolutely. You know, it's a blessing to be, obviously this is our 15th year in business in the Valley. And so fortunately, this is our second or third time that we've had the ability to prepare for something that was kind of like an overnight change in just the entire way we do business. But right now we're getting an influx of calls. Of course, we have the traditional clients that are being referred by lenders, wanting to purchase, maybe perhaps because they were pre-qualified once before and now suddenly not because of increased FICO requirements and things like that. But I'm seeing, quite frankly, a lot of professionals, business owners, people in and out of the state of California, a lot of, what do you call them? 1099 employees that are calling hysterical, calling that they're out of work, a lot of hairdressers, the obvious that are not allowed to be like working right now, of course, and they're hearing all kinds of concerns about the forbearance pros and cons, which we'll talk about here in the next few minutes. But essentially, as we all know, not everybody has saved 3 to 6 months worth of income for a rainy day. And so the amount of intensity on the phone calls right now is hysterical. And we've got people, Marianne and I talked several times this week, actually, where, I was almost brought to tears with frantic phone calls with people, real estate agents as well, whose businesses were either just getting started perhaps, or maybe they had just invested a ton of money in marketing and suddenly now, because they aren't seasoned yet in the industry, feel like they've lost everything. So certainly, we have a heart for that. And when we're talking to people, we really want to provide an environment where we can listen and then create solution-based conversations. And so I was grateful for this opportunity to moderate this panel. I highly respect all of the lenders on this panel. I do business with all three, coming from different areas of the industry. And I just wanted to kind of touch base on the fact that if anyone on this call has any questions, or this Zoom meeting has any questions regarding their own personal credit, please consider us a valuable resource, not so much to, obviously we want to earn your business, but the real heart of it is that if you have concerns about your own personal income, or you have concerns about how to budget or strategize, or how to essentially get through the next 3 to 6 months, we wanted to create an environment where you had trusted referral partners to just really answer those honest questions, not just for your clients, but also for you. The saying, we're stronger when we're together, when we stand shoulder to shoulder, is obviously very true. And so I'm obviously honored to be considered one of those resources. And so I thought we'd just get started with the panel of questions and ask the panel. I'm going to ask the questions to specific people, but my hope, or our hope, is that each of you would chime in if you can, possibly, to address from different perspectives the answers to some of these questions. And these questions came from our power team, our real estate power team, as we were talking, but also they're frequently asked questions that we're all receiving by our clients. So I thought we'd cover them. We'll start with number one with
Bill Provost. If anybody on the call has questions, please drop them in the chat box, and Lisa Wayman and Garen Parker are going to be fielding those questions, and we will bring them up towards the end for the Q&A.
Okay, perfect. So the first question, so we thought we would divide the questions from one subject to another because we wanted to cover, of course, multiple subjects and wanted to stay cognizant of each person's time, and we don't want to overdo the time. So regarding forbearance, which is going to be the hot topic for now, and for maybe quite some time. Bill Provost, this question is for you. If you could discuss a little bit what the difference that you're seeing between, we've talked about the forbearance comments being placed on credit reports, but you had mentioned that you've even seen the words natural disaster appearing on a credit report, that versus deferment. So what are you seeing and what are the differences between those three scenarios?
Sorry, guys, I was still muted. So I mean, there's the Wild West on so much of this stuff right now. I mean, everyone got told by our regulators through the CARES Act that, look, just go get your forbearance and it's going to have no impact on your credit. But what we're seeing is like you mentioned, there's really 2 and even 3 different things that we're seeing that, the creditors aren't really marking anyone late. I haven't seen that yet, but they are putting in the notes forbearance, and then we're seeing this natural hazard thing. And I've actually seen 1 or 2 that just said deferred. And I mean, I want the other people to chime in on this as well, but deferred and forbearance are essentially the same thing. I mean, you're asking for the payments to be deferred somewhere. It's not forgiven. It's not a modification. Well, it may be modified and put on the end, but forbearance and deferment are essentially interchangeable. And then the one other thing, and I was actually chatting with Tobie about this yesterday, is this whole natural disaster thing that's showing up. And, the problem is we're not sure what impact any of these are going to have on either your credit score. Well, Tiffany, you can speak to that because you've seen some actually have a negative impact, but there's some of that going on. But then there's also what's going to happen when they get into underwriting, right? Is, what are various notes by creditors going to say here? And it's tough. I mean, the thing is lenders see forbearance. That means they're not paying. And that's an automatic huge red flag, right? So we got to be really, really careful with any of those things that are showing up. For what it's worth, as best as I can tell right now, the natural hazard or natural disaster verbiage appears to just be blanketed by some servicers to just be added as a note into these into borrowers' credit reports. And we're not sure. I mean, I haven't seen it have any impact on a credit score yet. So I just think that's a blanket statement. And right now it doesn't seem like it's having a negative impact.
Okay. And then, so Christian, you and I have talked offline a few times. You asked me a couple of questions recently, and I wanted to see what has changed or what are you seeing in terms of, how often are you seeing the words deferment or natural disaster and or forbearance? How often is that coming up? And if it does come up, what are you doing?
I haven't seen the natural disaster as much on mortgages. I've seen it on like auto loans, installment loans, things of that nature. And I assume it's probably the same thing due to COVID, that's what they're putting in as far as natural disaster. I haven't really seen it on a servicer yet. The ones that I've seen are forbearance and deferment. And, I don't know, when we look at deferred as far as on a credit report, student loans, I mean, those go into deferment. I don't know that really affects credit, right? But the word forbearance, that's just like a killer right now. And, there's a lot of people and a lot of lenders from the wholesale side of things when we look at it and we look at all the lenders that we deal with, majority of them are going in and saying, hey, look, we're not going to do a refinance for someone that's currently in forbearance. And I don't know that they know that or that they've even asked for it. And, I think we had one where like literally the client asked about forbearance, hadn't even been at the end of the month yet, made their mortgage payment, but was still tagged with forbearance just because they had called, asked for it. So the person probably noted, hey, borrower called in for forbearance, and it got put on the credit report. But, we've seen that. We've seen where they've marked it a 30-day late. Remember, we had an example where they did mark it as a 30-day late on a forbearance. Mm-hmm. And all those things are going to be a lot harder to get off of a credit report when they're already put on there, right? People already say, well, don't worry, they'll remove it. But yeah, like I'm gonna pay $150 and or whatever it is and $80 a month to get Tiffany to remove it because they're not gonna remove it for me, right? That's the reality of it. So, good for you, bad for the client, I guess.
Yeah, well, obviously we want to be a resource. I don't want to make money the wrong way,
right.
Of course. But I do want to just touch on that before I jumped over to Tobie because I want to ask her the same thing. From a credit perspective or a FICO perspective, the words forbearance on average just reporting alone, we are seeing we said 30 to 38 point deduction. So by the way, that is on about 12 different files. So obviously that's a small amount of people, and in relationship to how many people are doing it. So obviously it's new enough to us as a small enough company to where I don't have hundreds of examples, but we have seen a pretty standard amount between 30 to 38 points from the words forbearance hitting the report. Yesterday we did some research. We did reach out. The words forbearance will not ever be removed from a credit report unless it's been 7 years. So you would have to ask them to delete it, proactively contact the creditor and ask them to delete it or dispute it off the credit report. So it's not something they're anticipating will fall off the report automatically. And the reason for that is that the credit bureaus are responding with the fact that they're saying it's not a negative remark. They're saying the 30-day lates are the negative remark. And so there would be no reason for them to adjust it. And they're stating, officially, all three bureaus are stating that the words forbearance are not negative on a consumer's credit profile. And then we say, well, if that's the case, then why would FICO be taking points away? So just something to be cautious of. Tobie, I have a question for you similar to that, if you can add on that. But in terms of forbearance or refinancing, what are you doing, or what are you advising clients that are making those phone calls and they're getting the forbearance placed on their credit profile?
Well, so two things on that. To speak to how much I'm seeing it is I have seen it quite a few times on refinances, obviously not any on purchases at this point. So that's a good thing. But on the refinances, from our take, and every lender is going to do things a little bit differently. In order to complete the refinance, they're going to have to come out of forbearance because it holds up getting a payoff and different things like that. Now, as far as what I am, talking with my clients about is each servicer is going to be very, very different on the options that they give, the way that they report it, and different things like that. And just making sure that if you absolutely need to, of course, take advantage of that. But if there's any way to, to make it happen without doing that, in the long run, it will be better for them, especially if they're looking to, move up down the line or purchase, or in any case, if you can make the payment, make the payment. Okay.
We're also getting a lot of questions regarding how the COVID-19 situation just in general may be affecting pre-quals or I think we put the word credit refreshes, refreshes just because we are not in the industry, but how is that affecting the ability to pre-qualify someone? Is it any different now?
It is different, but it's not different. There's just added questions, right? You're looking into the employment, like what type of employment you have. Have you been furloughed? Are you going back? What are, it's additional questions. I mean, for me, it's the same pre-qual process, except there's, 5 more questions at the end to really vet those out. And there are some service industries that are at risk, and there are some that are not. So just vetting that all the way through and making sure that, you're having those conversations and those expectations with not only the clients, but the agents that are involved and those different types of viewpoints as well.
Okay. And then, Bill, I'll start with you on this one. So we're getting this a lot. So how is the COVID-19 forbearance situation, how is that impacting interest rates and or FICO score requirements for loans?
Okay, so there's two kind of varying things. So as far as credit scores and stuff like that, I mean, generally, FHA, VA, and conventional have pretty much left LTV, so loan to value ratio, debt to income ratio, and credit score, left them pretty much untouched. What you will see though is, there's also, every lender's got to be able to sell these off. So you're seeing a decent amount of overlays for minimum credit scores. And so literally every lender is going to be a little bit different right now. Like Franklin for government loans will only go down to 600 for FHA and VA. Conventional still 620 like it's always been. So the nice thing as far as conventional FHA and VA still fairly similar. Now jumbo's a whole new world where, I mean, jumbo, if you don't have a 700 credit score, you're going to run into real issues. minimum 700 credit score, minimum 20% down in almost every case. So jumbo is a different animal. So, here in Riverside County, everything over 510 gets a little trickier.
Christian and Tobie, did you want to answer that one too?
Go ahead,
Sure.
Tobie.
Okay, so just like Bill says, so I think that every single lender, everybody has to do what works best for them and their different placements when it comes to liquidity. At this point, we're still just following FHA and VA, but our overlays have been more from an aspect of compensating factors like more reserves, lower debt to income ratio. So they haven't necessarily changed the FICO score requirement for us, but they've changed the different things. So if you have those lower FICO scores, you're going to have to show some different compensating factors to make sure that they can offset that lower FICO score.
Okay.
Yeah, I think, I see it from a different world than Bill and Tobie, just because I deal with, 60 different places where I can, right? But I mean, they're right. Like literally I have some lenders that are at 580 still, like Tobie said, like for government stuff, like you go down to 580 or 500 on FHA, but you better have some compensating factors that you didn't need before. And they're feasible to get done. Whereas then you have, other lenders that are like, I think one of my past employers, they were at 660 on government stuff right now. And they have to get an exception to go lower, right? So like every company has different avenues on the way they want to go. And also, you've seen stories of like literally it being in process and the lender is going back and reviewing those ones that are currently locked and making a decision whether they want to do those loans or not still. And it's unfortunate, I've seen clients that literally the lender decide not to do it 2 days from escrow, we're trying to pick it up, and it's literally because they don't have a place to sell that loan. And so we have that broad view where, Tobie's place may require 2 months reserves, but like we may have a place that requires 6 months reserves, right? Or 0 reserves, or Bill may say, well, I don't need any reserves. Like literally it used to be like shopping for gas where like we were all pretty much the same. We sold the same product. We were different by like, well, which side of the street are you on? And do I really want to turn and use the ATM machine for 35 cents and get cheaper gas, right? But now it's like, well, like Bill can't do it, but maybe I can, or like I can't do it, like, so maybe Tobie can, or like send it over to this place because I know that they can do something at 640, right? Jumbo market is just completely, if they're self-employed and they need a bank statement loan, like don't come to me right now. Maybe try Tobie or try Bill, but don't try me. And if you need a jumbo, it is. We used to have 15, 20 products for jumbo, and now we have 1 or 2. And so, like Bill said, anything over 510, 400 is a jumbo product. And so the way to combat that, luckily we still have a first and second product, right? So for agents out there, but again, a lot of the second companies are stopping to do HELOCs now that they're standalone. So although it sounds like doomsday, it's really not. There's still a lot of products out there and a lot of loans. It's just, it's harder for people with lower FICO scores to get a loan right now. And it's tightening up because the liquidity, like they don't want to be stuck with these loans right at the moment. So rather than doing them and then having issues with them later, they just won't do them right now. And it'll come back. But, if your client has less than a 620, you should probably be worried that they can get a loan somewhere. I'm just speaking in general, right? Like, can Bill do it? Can Tobie do it? Can I do it? Yeah, but in general, 620, it becomes probably a lot harder to get a loan nowadays. And so, I think we're just better warning our clients like, hey, look, this is going to be a difficult loan. Like, I'm going to be stressed during the transaction. You're going to be stressed. Everybody's going to be stressed, agent, everybody, because of just the times right now. So, just patience. Patience is a virtue.
I'd like
It
to add.
always is a virtue, for sure. Okay, then this is an important question. So we have a lot of renters calling, asking about, gosh, I don't know if I'm gonna be able to pay my rent. And then we have, of course, landlords and homeowners that are renting out their homes saying, how is this going to impact me if somebody that I, have in my rental home isn't paying? Have either of the two of you had any insight, or do you have any insight as to the difference between what a mortgage forbearance looks like for a rental property versus primary residence? And maybe in terms of how and maybe an underwriter would look at this situation?
I personally have not had any experience with that yet. I know from, I have had clients that have inquired about that, and there are some specific, the care site addresses some specifications for renters. When it comes to us as the lender looking at somebody that has a forbearance on a rental property, I haven't seen that or had experience with that, so I don't know how the underwriter is going to look at it. But I will tell you, let's just pretend that they didn't go into forbearance, the renter's not making the payment. From a lender standpoint, we always only give 75% of the rental income to factor in an occupancy or non-occupancy factor. So from a qualification standard, when taxes start to come out, we're going to see something different there. But as of right now, I think from what I'm seeing, it's a little bit too soon to know exactly how that's going to impact investment properties.
Okay.
Well, and I can jump in there a little bit too, because I know we were talking about going back a bit on the forbearance topic. I think that's another area where, it's not just a forbearance on your primary residence, right? I mean, where this is going to start coming up, and I've seen it twice now where I'm helping a client. One was a purchase of a primary, the other was a purchase of an investment property, and they had requested forbearance on a different property where they didn't get paid their April rent. And so like now they've got forbearance on their credit report, right? So, I mean, all these things are really fluid, but it's like, that's one of those areas where it's like, oh man, so the renter doesn't pay. So then the landlord has a hard time paying. And so they ask for forbearance. It sounds like a free ride, but then their mortgage company puts forbearance on their credit report. And it's like, it makes everybody pause for a second and ask, are they going to be able to sell that loan?
Mm-hmm.
Well, and guys, I think I ran into a situation. It wasn't on one of my clients, but I think Fannie released something saying in order to be able to use rental income to help a borrower qualify for a refinance, we have to make sure that they made their April payment. The renter made their April rent payment. And so the moment, and I imagine that's probably going to continue, that there's going to be some type of guideline that says, if we're going to use this rental income, fine, we can use 75% or normal qualifications, but we have to make sure that that rental payment was made that month that they're going to fund the loan. And the reason why is because, you're using that income, even though we use 75% of it, they don't know how long it's going to continue. And all of a sudden, if they miss 3 months of rental payments, well, that's over that 75% anyway. So I foresee you're going to see that if they try to go and refinance their rental property or use rental income, even to qualify for a new loan, if it's going conventional, we're going to have to probably make sure that the renter is making that payment and proof that they made their payment.
Okay. The next question is, how is this impacting, and I think the messaging was, how is the forbearance scenario impacting the commercial real estate market, and can anyone speak to that?
So I personally don't do commercial loans, but you can see this is all, commercial's gonna have the same problems that residential is having, right? I mean, there's loads of those. Think about the businesses that are completely shut down right now, right? Restaurants, all the services, haircuts other than Dahlin's guy, and all these people, right? And I mean, they have zero income in a lot of cases. They're just going to skip their payment, right? And because the feds have given everyone a green light to do it, but there's still a mortgage underlying almost all of these properties, right? So the commercial side, I'm almost more worried about the commercial side than the residential side right now, to be perfectly honest.
Yeah. Okay. Before we go on to round two, which is off the subject of forbearance, should we go through the list of questions that we have right now, just so that we don't move on before we address them?
Yeah, let's do it.
Sounds good.
Yeah.
Tiffany, I have my first question is for you.
Okay.
It is asking, sorry, I'm trying to scroll. Even with no mortgage late payments, the scores are still dropping 30 to 48 points just by forbearance being noted in the note section of the credit report.
So the answer was so it's 30 to 38, not 48. So it was 30 to 38 is the average. And we are seeing that the mortgage forbearance remarks are affecting the scores. Now, the key is also, you have to understand too, that most of the lenders right now are not reporting any payment history for 90 days. So not only are they putting the words forbearance on the credit report, because they're not legally allowed to put a 30-day late on the report, they're simply not reporting at all for the next 90 days of credit history. For the most part, some are putting are showing on-time payments. If they are, if they aren't, they aren't. But the problem is the lack of payment history in and of itself is 15% of the FICO score. Just like 30% of the score, of course, is your utilization of credit. So it's hard to tell right now if it's just the words forbearance or if it's also the words forbearance and then just a lack of payment being made at all. So from that perspective, yes, that is the standard answer that we're giving, and it's been pretty across the board.
Okay, great. Next question is probably for everybody on the panel. It's asking, is a broker a better option than a direct lender? Or if a direct lender has an approval, can they change in the middle of a transaction?
I'll talk. I don't think it's necessarily a better option. I think right now we're all kind of using the same thing. I think there's some advantages to direct lending right now because they some of them hold their servicing, and so they're willing to make an exception or bend the rules because they know they're going to maintain that servicing. So that what they're going to do is not sell it. So they're in hopes that they can sell it down the road. But for right now, they're going to hold on to it so that they are okay with, well, normally we ask for a 620, but we'll do it at a 600, or, bend the DTI rules. Whereas a broker, like lenders are, it is what it is, and we'll go back and cancel your loan if it doesn't meet it. On the flip side, I think, every once in a while we have a place where, I can go from, right now 500 on an FHA up to, places that are 660. So we have options, but, at the same time, we all know dealing with someone with the 500 FICO, like it's going to be a rough transaction anyway. So like, are we taking it on during this? Like, Bill and Tobie would probably be like, oh, you have a 510? Yeah, like Christian can do it. Like, he'll do it. Like, oh, yeah. And I mean, it's fine, like I have an option to do it.
Good to know. Christian will take those on.
Yeah, I'll take those on all day long. But, hold on. Not everybody on this call send me those clients right now. But that's, I think there's pros and cons to it, right? I think there's definitely cons to, pros and cons to being a broker and also direct. I think, I think it's, I definitely think there's they can speak to it.
Yeah, I would, Christian, that's well said. And it's really kind of always that way, but for sure right now, we're all going to have pros and cons.
And I agree with both Christian and Bill. I think that there's no one that's better than the other. It's just, it's you have to look at the specific client and who you're working with too.
Great, thank you guys. This next question is just for Bill. He is asking what the outcome of the applications where the borrower had forbearance on the property. What was the outcome? Did it affect the client qualifying?
So I'm looking to still close both of those, but what we've done is we've had them, we're verifying that they did make the payments. So I've got my fingers crossed that those are both still going to go, but they're definitely getting questioned. And then of course, what our ops people are going to do is they're going to figure out, like, do we have a home for this? Can we sell it direct? Because ultimately what all of us lenders, and it doesn't matter who it is, we're just trying to make sure that that's not a loan we end up buying back. So that one's a little scary right now, but I'd say we're looking like they'll probably both go as long as they make their payments.
Great. Last question for this section is, I was under the impression that the CARES Act is not negatively reporting. So I feel like you guys can all comment on that. Maybe Tiffany, you want to take this, or?
Yeah, absolutely. So, yeah, that's kind of the issue, right? I mean, I think we've talked about this multiple times in multiple venues, but at the end of the day, the news, when you watch the 5 o'clock, I don't even know what time it is anymore. It's 5 o'clock, 7 o'clock. I don't know, whatever time the news.
Somewhere.
Yeah.
When you watch the news, they're proactively asking consumers, hey, listen, if you even think for a minute that you're going to be underemployed or unemployed, call your mortgage company and find out what your options are. Don't be reactive, be proactive. And then they immediately cite the CARES Act and tell you you're protected. You don't have to make the payments, right? So it's almost like they're encouraging it. And then, the consumer says, okay, fantastic. I don't necessarily need the forbearance yet, but who knows what's going to happen. Maybe I'll take advantage of this situation. And then they're being told there will not be damage to the credit report. And part of the problem when you've got people in politics making regulations or bold statements that they're not really educated on, they're unaware of the fact that it's more than just the 30-day late that affects the credit. Just simply not putting a 30-day late on a report is like a quarter of the piece of the scenario, right? So we're looking at the FICO score itself being damaged by the words forbearance or the lack of payment history being reported, like we mentioned. I mean, those two factors are outside of a 30-day late being reported, and they damage the scores. And we know it's happening. It's not even a guess anymore. We're not assuming. We're seeing it real time. So although the CARES Act was supposed to protect people from getting those 30-day lates, the good, the bad, and the ugly of the truth of the whole scenario is it's happening. So we'll go into a little bit later about the options that consumers have to kind of, counter that. But yes, the CARES Act in and of itself was well-intentioned. But like Bill has said, several times on several meetings I've attended with him, that's what happens when you slap a policy down that you had about 22 minutes to create. There wasn't a whole lot of, ability to consider all the things that could happen. And certainly there's a lot of peripheral consequences from the CARES Act not being completely thought through. So there's my long-winded answer to that question.
Great.
Okay. Round 2, ding, ding.
Mhm.
All right. Adapting to the new normal. So, at the end of the day, thank you all three of you guys for being willing to sit in a non-competitive environment and just share from your hearts and your knowledge, because at the end of the day, that's really where all of us are getting such value. So I want to say thank you on behalf of everyone on this call that you would be willing to do that. The first question that we're getting a lot is, okay, we get it. The forbearance thing is a lot. But is there a loan program that's less affected? Is there a market that realtors could just be hitting hard right now, so that there isn't so many hiccups or concerns with, I guess, what's going on?
Yeah, I'll take that just really quick. I mean, again, just conventional FHA and VA are still a great way to go. Christian mentioned a great point, which is, don't forget, yes, jumbos are difficult, but don't forget there's still HELOC options out there for second mortgages to, so that you can still get to that jumbo limit. Just do a 5-10 first and a bigger second, or a second of some sort. So yeah, I mean, I think great point, right? I mean, look, the sky is not falling. I mean, look, we are clearly in a very, very difficult time, and there's lots of unknown coming at us seemingly every day. But the reality is what's happened is the box has just gotten a little bit smaller. But there's still a ton of business out there, and it's still a ton of people that are going to get great mortgages at ridiculous interest rates right now.
Yeah, we're going to get bumper stickers that says "Be nice to your loan officer" right now, because we're having a hell of a time. It is, I mean, really, if you're looking at a group, I mean, as much as I hate to say, like essential workers, right? Like, we know those aren't going to lose their jobs. So, if you have a great in with, civil servants or whatever those essential workers are, like, hospitals, nurses, whatever, I mean, go for it, because those, we're not going to lose their job. But, I mean, it's really hard to pick a certain category, because you could have 10 people all with 750 FICO scores making great money, and 2 or 3 of them are going to lose their job if we're at 24 million unemployed right now. And there's no way to know which ones those are going to be unless they're an essential worker or not. So, I don't know that there's Yeah, maybe stay away from the jumbo market and stay away from, 500 FICOs and head towards the essential workers. So like after this, we can all have a party at like Kaiser and like go pick up clients, right? Or at Loma Linda.
Yeah. And I agree with both Bill and Christian. I think that, the FHA, VA, your conforming limits, but don't forget the lines of credit, like Bill mentioned, those are huge right now if you're trying to push over that. And then our active duty service members as well. Interest, VA rates, all rates are at an all-time low. VA rates right now, there's a lot of active duty military that have been priced out of the market, and the prices haven't necessarily changed, but the interest rates have dropped, which has increased their purchasing power. So that's another area maybe to hone on in a little bit as well.
Okay, and then I have another question that is coming up quite a bit, and that is, all right, so what has changed in the loan process in underwriting, from an underwriting standpoint, and regarding delays? You mentioned employment verification once before. Anything changed in that? Is it our time frame still the same for closing?
I would say yes to that. There are more verifications throughout the process as far as employment goes. Used to, before all of this, we verify in the beginning and then a quick call at the end. Now there's about 3 verifications throughout the process to make sure that the client is still employed at the end.
The day of funding, they'll do verification of employments now to verify that the borrower still has their job. So I think those are, for people that are teachers, things of that nature, we're using cell phones and things of, bosses' cell phone numbers to verify employment, and those things that we normally wouldn't have used in the past or had to do, as long as they had their job within 10 days of funding, we were typically good on that.
Yeah, I think the only thing that I might add to that is just we're digging so much deeper, particularly with self-employed clients and things like that. Underwriters are just a little more skeptical of that than they used to be. They're looking a little closer at, what they do, what's the real likelihood their business has been unaffected, some different things like that. So, I think this is an area where, as a team with the realtors and the mortgage companies and the mortgage people, is like, hey, realtors, please help us with understanding, like, this is going to be, we're going to dig even deeper than usual, and help us with some of that communication. I think a lot of people just expect it, of course. It's like, of course, lenders are going to have a harder time giving out money, but, just know that we're definitely digging deeper than usual, particularly on the employment side, and just some good communication about that helps a ton.
So if you're self-employed, don't put that your business is closed on Yelp. That doesn't help.
Yeah.
They'll look. I'm telling you, they'll look.
It's funny. I had one where my underwriter was actually in it on Sunday looking to verify, and it said closed because they weren't open on Sunday. And that almost caused us a wreck, but that's a great point, Christian. Yeah. Google the company and figure out what it says online. Could make or break you.
That's a good point. Okay, so changes to guidelines. Can you all three talk briefly about down payment assistance? Is it still available? Anything changed where that's concerned?
Go for it, Tobie. This is your world.
No, right now it's not my world. So, CalHAPA they are still lending from everything that I can tell, but I think that most lenders have stopped doing those bond type of programs just due to the volatility. I also noticed that on the CalHAPA website, effective May 1st of this year, they're going to be lowering their debt to income ratio again. So I think down payment assistance is going to, I think we're going to see that maybe not completely disappear, but drop drastically in the way of availability in the coming months, because it is, because of the volatile market that we're in right now. So I think that we're going to see less and less of that going forward.
Yeah, coming from an aspect of seeing multiple lenders, we still have a handful that do them, but we have, a bunch that don't do them anymore. And I think Cal Hoffa moved their credit scores from 640 to 660, right?
Mm-hmm.
Open Door moved their criteria up from 640 or what have you to 680 for most places, I think. I think Platinum, I think I just saw, raise their criteria up to 660 as well for FHA. So a lot of, again, it just goes into making sure that the borrower is more qualified and that we're not just getting by with someone on the skin of their teeth to do a loan nowadays. And I mean, they're the same old loans, just a little bit harder to get right now.
Okay, and then last questions before we get up to the wrap up here real quickly. Any predictions regarding interest rates, home prices?
One thing I wanted to address, and this is, I think, really good, is we talk about rates and where they've gone and everything, and although rates are super low, like lender credits have gone by the wayside for the most part. So like everybody has to now talk to their sellers like, hey, like we're going to have to start giving money back. We're going to have to start giving closing costs, because a lender, we used to be able to raise the rates, go up to 4% and give the guy $7,000, $8,000 and like get them into the house with free, nothing there, and stack them. And now, if we get $3 or $4 grand, like loan officers like running around like thinking like they just saved the world. And the reality is that there's no money in these loans right now, so everybody understands. And then a lender is going to go out and give $4,000 because we raised the interest rate, or $7,000, and then all of a sudden, when this is all over, they're going to go back and refinance it and get out of it in 6 months. And they gave $7,000 refinance; they didn't make any money on the loan. So I think that's the new normal for a while. Is that you calling your loan officer and saying, hey, like we're going to submit a full price offer, but I need you to cover the closing costs on FHA or VA. Like, no, I got you maybe $2 or $3 grand, and like, maybe somewhere in that ballpark, but the days of covering all of them are gone, because if we raise the rate, and this is probably Bill and Tobie the same way, we raise the rate to a certain extent, it actually starts costing the borrower money again, because the lenders are trying to detract from people taking a higher rate right now. So refinances, a lot of people are using discount points now. Purchases, some people are paying points right now. Lender credits are kind of gone. So although rates are really, really strong, the cash to close has gone up.
That is a fantastic point, Christian, because I think that that's something that it's not being talked about a lot, is that we do have those fantastic rates, and the lender credits and things like that are much, much less than they once were. The other piece of that comment is that if we are dealing with clients with those lower credit scores, then what's going to happen is you can still get them a loan, but the rate can only go so high. So what does that mean to the client with the lower FICO scores? It means that now you can't pass that risk on through interest rate. You're going to pass it on through fee, and that's how the investors are going to look at it. So for that client to get into a home, it's going to cost them more money that they already don't have. So those are two very big challenges that as a lender we're dealing with daily in our world, I think.
That's
yeah, you guys have nailed that. You're 100% right. It is something that needs to be out there, because we're just so used to being able to give lender credits, and right now it's just really, really difficult.
Would the three of you be open to the idea of collaborating with other local lenders? We talked about this before this meeting, to continue to stay apprised of just all of the forbearance scenarios, and just to continue to be able to say, this is what, that these are the 6 files that I had with forbearance, and what are you seeing? Would you be willing to do that to keep our realtor community updated?
Absolutely.
100%. Yep.
Absolutely.
Okay. Did we want to do wrap up with credit issues, or did we want to do just general questions? Garen on the call?
There's no questions, Tiffany, for part 2, just FYI. I don't know where Garen is. I think he's here, but he may be muted.
So just to wrap up, I was asked to do some wrap up questions regarding credit, and I'm happy to do that. I'd love for the lenders to chime in too, though. I think this is important that we all work cohesively on this. But when we were coming up with questions, some of the main questions are, what's the difference between FICO score consequences? Essentially what we're getting asked is, listen, the forbearance hit my credit report. There was nothing that I could do about it. Thank God they gave me the opportunity to do the forbearance. How long is it going to affect my credit? Well, like Bill and I were talking yesterday, really, they're not asking, how is this going to affect my credit? Although that's what they're saying. They're really asking, how soon until I can purchase again? Because the technical answer to how long does it affect my credit is 7 years, right? So we know that a forbearance or any derogatory item hitting your credit report is a 7-year penalty. We also know that a 30-day late, should it hit your credit report, will be 60 to 80 point deduction within the first 30 to 45 days of it actually occurring. But the real motivation behind how is this going to affect my credit, most of the time the buyer's asking, when can I buy? Or when can I refinance? And how quickly can I recover from the fact that this has happened to my credit? And so that's really one of the main things I wanted to touch on. I think that's where people get confused when they say, when they're talking about credit, they're really talking about how soon can we hit the ground running again. So I just wanted to mention that the difference between underwriting guidelines and FICO score consequences are very, very different. And unfortunately, we need to be better at asking, or maybe fortunately, we need to be better at asking, what are you really asking when we're talking to the consumer, so that they have those questions. And I wanted to touch on that because the second and third most frequently asked questions are, how long does it stay on my credit report? And I thought that it didn't hurt my credit. So we kind of touched on that already. I have been getting this next question on here is, how do you recommend consumers monitor credit? Obviously, if you have a 500 FICO score, probably most of the lenders on this panel are going to say, hey, listen, I don't really want to pay to run your credit. If you know it's a 500, figure out a way to pull your credit. So I just want to mention that the real true blue, absolutely accurate, 100% best website is myfico.com. And that's MYFICO. It's one of the only websites that's actually owned by Fair Isaac Corporation. It's for totally for the consumer. The consumer gets their auto FICO, their mortgage FICO, their bank card FICO, installment line FICOs. I mean, there's FICO 8, 9, 10. There's so many different versions, and each lender uses a different variation of those. But it's a true FICO score, and it's a soft inquiry, so it's not going to drop the scores. The downside of myfico.com, of course, is that it's $35 to $40 every time you run the report, but you get what you pay for, right? So I always tell people it's, Credit Crappa, or otherwise known as Credit Karma. Seriously, other than looking at it for like real-time updates and just kind of like trending, it's kind of useless, right? It uses the Vantage score. But right now, something is better than nothing. And if you're that person that called to inquire about a mortgage forbearance, or someone that is, now would be the time to be watching that credit report like a hawk to make certain that they didn't put a 30-day late. And if you did drop in score, call me. Let's look at it. Let's find out, was it because the word forbearance hit the report, or was it also because there was a lack of payments made, or was it just the inquiry itself? So wanted to touch on that. 2 more credit trends that we should probably discuss is that Capital One, some of these major creditors, especially Capital One, they're not reporting any payment history at all right now. So I have clients that are calling me frantic clients, and then prospective clients saying, I've never been late. I have no idea what's happening, but my score just dropped 40 points. Can you look at my credit report? We'll take a look at their credit report and go, well, there's 3 accounts aren't reporting this month. Well, they weren't late on the accounts. But again, when you don't have ongoing payment history reporting, you lose points dramatically on your FICO score. So it's a temporary drop, but I just want people to be aware of the fact that your on-time creditors, specifically credit card companies, many of them, such as Capital One, are just simply not reporting right now. And if that's the case, that's going to affect the score. So that's number 1. Number 2, we're also seeing that, I hate to keep picking on Capital One, but you guys know how I feel about them. If you know me very well, it's one of my least favorite creditors. But they're also closing accounts. So they're looking at people who have inactive or low usage, and they're either soliciting clients to pay them off in full, and they're closing. They're closing the accounts on individuals, even if they were never late. So now is not the time to be aggressively paying off credit cards. I've been saying that all along. As much as it would make probably really wonderful financial sense to do that, it's not good FICO sense right now. So I would say you get just as much bang for the buck paying it down to 5% utilization than paying it aggressively off and then risk the fact that the credit card gets closed on you. So those were some newer things. I will also tell you TransUnion, Experian, and Equifax just recently published an ad. We're waiting to see how it's going to shake out, but essentially they're encouraging consumers to now go online and get a free copy of their credit report from each of them once a month rather than once a year. And they're implemented that as of last week. The downside, there's always a downside of doing that, is it's encouraging the consumer to dispute items online on their own and not to use a company. So obviously we don't love it, right? But you guys know that when you dispute online, just be alert to the fact that it circumvents the Fair Credit Reporting Act out of the process, which means then the credit bureaus have 90 days to investigate a dispute rather than 30, which clearly will affect the ability for it to be successfully removed. So at the end of the day, knowledge is power, and I think that's what we wanted to address here in this panel. I know the Real Estate Power team works super hard to put these together, and I was honored to be asked to moderate. And I think we had a couple questions come up, so we can address those now.
Tiffany, one question we got is, can you still do rapid rescoring for clients?
So a rapid rescore is actually not performed by me. It's performed by the lender. Typically mortgage lenders will do those if a consumer can demonstrate, for example, that they've paid off 3, 4, 5 cards and they want to, rapid rescore. It's a pretty expensive way to go. Some lenders will offer it. But what I can do is run simulations, and our simulations are extremely accurate. So it's more of a simulation directly tied into Fair Isaac Corporation, showing what the likelihood is of the score based on certain circumstances.
So rescores, just really quick, and I will say rescores, lenders usually handle those, I think. Excuse me. And so they are still getting done. I think you just have to be patient with it. The credit companies are all working from home. I just got an update from our credit company the other day that said, expect, for whatever reason, TransUnion apparently is very, very slow right now. So I don't know. Yeah, so rescores, technically yes, but that normal 2, 3, 4 day turnaround, I don't think anyone should expect that right now. And
remember that bumper sticker
is the longer a rescore takes, the less accurate it is, and the harder it is to make it work.
Okay. Another question we have is, other than exploring a refinance, does anyone have any other options or ideas to provide our clients in lieu of forbearance?
Instacart. Start delivering Instacart. Hey, it's essential. I don't know.
I've been telling my clients, and this is something that, we're fortunate that we have a lot of business owners that are client, that come to us, are business owners. And interest rates are extremely low right now for some of these business lines of credit, although none of us want to take out debt. Obviously, we got to grab the lifelines that we have access to. And I know that there is a ton of programs out there available right now for, of course, business owners. But also, too, if you haven't been late on anything, or at least in the last year to 2 years, this is the time to be asking for credit limit increases on every one of the cards that you have that are older than 5 years old. Number one, even if you don't use them more, you don't want to necessarily increase your debt spending, it absolutely brings those FICO scores up to have a higher limit and a lower utilization rate. So, I guess that's kind of always been our saying, is don't wait till you need credit. That's why I always like for people to fix their credit proactively rather than wait for a pandemic to hit. But that being said, certainly we can work with clients, help them get those FICO scores up quickly to where they can qualify for some consumer debt option relief.
Next question is for Tiffany. How do your simulators vary from myfico.com simulators?
So that's a really good question. I always recommend MyFICO. Really, at the end of the day, it's not rocket science. If you look at it and you say, okay, I've got 3 cards that I just paid down to 25%, and you want to run that through MyFICO, I think by all means, pretty darn accurate. Where it becomes tricky is when you have open collection accounts that are unpaid and unsettled. And let's say you have 5 or 6 of them, all with different date of last activity dates, and obviously balances, and whether or not it's an in judgment or post judgment scenario, those get tricky. And so if credit repair was easy, you know, we wouldn't still be here 15 years later. So I will say that I think at the end of the day, run the simulations. If you're 5 to 10 points off, by all means, go for it. But if you need a solid 30 to 60 points to qualify, I would suggest having us run some FICO, you know, our own stuff basically to determine whether or not clients should be settling collections, and if so, which ones, which brings on a whole nother level of education.
Those are all the questions.
Okay, well, on behalf of the Temecula Real Estate Power team, I just want to thank every one of you guys for being on the panel. Tobie, you're absolutely amazing. Christian and Bill, thank you so much for being willing to sit with, sit with us all today and answer these very important, valuable questions. And then, of course, being willing to continue this conversation is just invaluable for all of us. So I appreciate that. Is there a way that we could all, if people have questions, we can just post your information, I'm assuming, and they can all reach out individually?
Yeah, of course.
We can
Absolutely.
in the recap.
Awesome. Awesome. Well, thank you everybody for attending. And hopefully this has been helpful. If you can share it, please get the information out. The more we know, the better the industry is.
Awesome. Thanks, guys.
Thanks, everybody.
Thank you. Bye.
Thank you.